So while our top story is GE, and our next guest says the Dresser and City deals are proof that the GE M&A machine is moving again. Steve Winoker from Sanford C. Bernstein is with us now. He has an outperform rating on the stock. Steve is the most accurate forecaster on GE, according to Bloomberg data. He's joining us now over the phone. Steve, we know GE has a lot of cash on its balance sheet, but we assume in these times price still matters. How would you rate the City purchase, the Dresser purchase on a frugality scale?
Good morning, Deirdre. I think that GE has most importantly needed to step up to the plate for investors and show that they weren't going to rush into filling the void that's going to be left by NBCU. So frugality is an important metric, and perhaps the most important, assuming that they're going to buy within their core units. On these deals, Dresser, $3 billion deal on $2 billion in sales and about 9.5 times EBITDA and about 13 to 15 times EBIT. I think that's in line with what you'd expect in a depressed industry where you're at trough profitability. And so, you know, considering that where the industry is, those multiples are actually pretty good. I'd rate that deal particularly highly for them. They're in their core business. They're doing what they said they would do. On the City deal, you're talking about $1.6 billion of assets, and you know, our sources indicate this was somewhere between a little below and a lot below book value, which I would sort of estimate closer, if I had to really estimate this, maybe closer to $1.3 billion or so would be my estimate.
GE
and that one is
didn't
pretty
release
good.
any details. You're just doing the math on it.
That's right. That's right. And that's what we would expect. I mean, you're buying it from City. City's in a position where they really are needing to get rid of a number of assets, and you would expect that it would be well below book value. Now, City had already, as you know, taken write-downs across a large amount of its portfolio. I would suspect that this was in there, and I think GE picked up assets on the cheap here. It's already a big business unit inside of GE, and so they just added to an existing unit, I think, with in a good distressed situation.
Steve, what does this say as far as credibility goes? I mean, it seems like GE is moving back to the future. They're getting back to its core: energy, healthcare, software, aviation. So does this mean the stock is going to go higher? It's had a rough ride in the past 5 years.
Yeah, it's been a very rough ride, very flat over that time period, and obviously in between, you know, really putting the company completely at risk. When you think about it going forward, though, about 70% of the earnings growth or more for GE over the next few years is coming out of GE Capital. And the core of the business is on the industrial infrastructure side. So I think Jeff Immelt is trying to reduce the overall exposure to capital and come back to the industrial and infrastructure roots that made the company great. And I think this is, you know, a step along that way. It's a good sign that he is not rushing to replace the dilution with big bad deals. I think these are good deals, and he is. I think this is the kind of thing you need to see in order to see GE also move back to where investors had held it earlier.